If everyone went to the bank tomorrow and asked for their money back, the system would collapse by lunchtime. Not because the money isn't there, but because it was never really there to begin with. What you call money today is mostly debt. And the strange part is, this didn't happen overnight. There was no announcement, no headline, no warning. It just became normal, and almost nobody noticed. Right now, every swipe, every transfer, every paycheck feels real, solid, earned. You work, you get paid, you save, you spend. Simple. But underneath that simplicity is a system that flipped quietly over the last century. Money used to be something you could hold, something scarce, something that couldn't be created out of thin air. Today, most money is created the moment someone goes into debt, not when value is produced, not when gold is mined, not when goods are exchanged, but when a loan is issued. That's the part that sounds wrong until you see how it actually works. Let's rewind. There was a time when money was tied to something physical, gold mostly. If a bank issued money, it needed reserves to back it. Limits existed. Expansion was slow, painfully slow. That constraint kept the system stable, but rigid. Governments couldn't easily spend beyond their means. Banks couldn't freely expand credit. Growth was limited by what physically existed. Then came a series of decisions, quiet at first, then permanent. The link between money and physical backing was slowly loosened and eventually cut. Money became abstract, which meant one thing: it could now be created. But here's where it gets interesting. Governments don't actually print most of the money you use. Banks do. Not by moving existing money around, but by creating new money when they issue loans. You walk into a bank to borrow for a house. You think they're lending you someone else's savings. They're not. They type numbers into your account. That's it. New money appears. At the exact same moment, a matching debt appears. Same amount, same system. Two sides of the same entry, money and debt, born together. This is where the system flips, because now for money to exist, someone has to owe. No loan, no new money. No debt, no expansion. Which means the entire system depends on one thing: more borrowing. Not optional, required. Think about that. If everyone suddenly decided to stop taking loans, no new mortgages, no business credit, no government borrowing, the creation of new money would slow down, then stop. But the old debts? They don't disappear. They still need to be repaid, with interest. And that creates a problem most people never see. Because the interest doesn't get created with the loan, only the principal does. So if the system creates 100 units of money through loans, it might require 105 to be paid back. Where does the extra 5 come from? It has to come from new loans, new money, new debt, which means the system isn't just based on debt. It's based on growing debt, constantly. And now the pressure starts to build, because this creates a strange incentive structure. Banks are rewarded for issuing more loans. Governments are incentivized to borrow to stimulate growth. Consumers are encouraged to take on credit to maintain living standards. Everything moves in one direction: expand. Expand credit. Expand debt. Expand the money supply. Because slowing down creates instability. This is why recessions feel so violent. They're not just slowdowns in spending. They're moments when the expansion of debt slows or reverses. Loans dry up. Credit tightens. Money creation drops. But obligations remain. So suddenly, there's less money chasing the same amount of debt, and something has to break. Here's the irony. From the outside, the system looks like it's built on wealth, growth, assets, rising markets. But underneath, it's built on obligations, promises to pay, future income that hasn't been earned yet, money that exists today because it's expected to be paid back tomorrow. And yet, publicly, we talk about money as if it's something solid. We say, the economy is strong, We celebrate rising asset prices. We measure success in GDP, market caps, and growth rates. But rarely do we ask, growth of what? Wealth or debt? Because in this system, the two are deeply connected. When debt expands, asset prices tend to rise. More borrowing means more buying power. More buying power pushes prices up. Homes, stocks, everything. So rising prices look like wealth, but they're often fueled by increasing leverage underneath. Which leads to another uncomfortable reality. If debt stopped growing, many of those asset prices would struggle to hold, because the fuel behind them would. And now, zoom out. At a global level, this system scales. Countries borrow, corporations borrow, consumers borrow. Trillions move through the system daily, most of it linked directly or indirectly to debt. And central banks sit in the middle, managing the speed of it all. Not controlling money as a fixed supply, but adjusting how fast debt, and therefore money, expands. Lower rates, more borrowing, more money creation. Higher rates, less borrowing, slower expansion. Everything hinges on that balance. Too much expansion, and you risk inflation. Too little, and you risk collapse. This is why inflation is so persistent. It's not just rising prices. It's a side effect of a system that needs expansion to function. New money entering the system, chasing goods, assets, and services. And because that money is tied to debt, stopping inflation completely would mean slowing the very mechanism that keeps the system alive. Now here's where it gets quietly absurd. The system depends on people taking on debt, but also expects stability. It requires constant growth, but fears the consequences of too much growth. It relies on confidence, yet is built on something inherently fragile. Because if confidence breaks, if people stop borrowing, stop spending, stop trusting, the entire structure tightens, fast. And yet from day to day, everything feels normal. Your salary comes in, your payments go out, the numbers move, the system works. Until it doesn't. This isn't a conspiracy. It's not hidden in some secret document. It's just how the system evolved, piece by piece, decision by decision, until money itself became inseparable from debt. And once you see it, you can't really unsee it. Every loan is new money. Every repayment destroys money. Every expansion creates temporary stability. Every contraction reveals the underlying pressure. So the question isn't whether the system is broken, it's whether it can function any other way. Because replacing it would mean answering something much harder. If money isn't created through debt, then how should it be created? Who decides? And what limits exist? Until those questions have answers, the system continues, expanding, contracting, balancing itself on a cycle that most people never think about. And maybe the strangest part of all this is that the moment money became debt, nothing felt different. No alarms, no shift in daily life, just a quiet transformation into a system where the thing we trust most is built on something we rarely question, and possibly don't fully